Welcome to the channel. The $100 rule that creates millionaires. There is a simple idea that has quietly created more millionaires than most people realize. It doesn't involve winning the lottery, it doesn't require starting a billion-dollar company, and it doesn't require a massive inheritance. In fact, it begins with a surprisingly small number, $100. At first glance, $100 doesn't sound like the foundation of wealth. For many people, it's the cost of a dinner, a monthly subscription, or a routine expense that disappears almost as quickly as it arrives. But when used in the right way and repeated consistently over time, that same $100 can become the seed of something much larger. This idea is often called the $100 rule, and while the number itself is symbolic, the principle behind it explains one of the most powerful wealth-building mechanisms in history. To understand why this rule works, we need to step back and examine how wealth is actually created. Because contrary to popular belief, wealth rarely appears suddenly. Most fortunes are not built overnight. They are built gradually, quietly, and often invisibly. The foundation of this process is something Albert Einstein once reportedly called the most powerful force in the universe: compound growth. Compounding is deceptively simple. It happens when money begins to generate returns, and those returns themselves begin to generate additional returns. Over time, the growth begins to accelerate. In the early stages, progress appears slow, almost disappointingly slow, but as the years pass, something remarkable begins to happen. Growth becomes exponential. This is where the $100 rule comes in. The rule is simple: invest at least $100 consistently, every week or every month, into assets that grow over time. Not once, not occasionally, but consistently. Because consistency transforms small actions into powerful financial outcomes. To illustrate how this works, imagine someone who invests $100 every month starting at age 25. If that money grows at an average annual return of around 8%, similar to long-term historical stock market averages, something interesting begins to happen. After 10 years, the person has invested $12,000, but the total value of the investment is already higher than that. After 20 years, the difference becomes even more noticeable. After 30 years, the compounding effect becomes dramatic, and by the time 40 years have passed, the investment may have grown into hundreds of thousands of dollars. The original monthly contributions were relatively small, but time multiplied their impact. This reveals an important truth about wealth. Money alone doesn't create wealth. Time does. Time allows compounding to do its work, and the earlier the process begins, the more powerful it becomes. But the $100 rule is not just about math, it's about behavior. Most people underestimate the psychological power of small, consistent actions. When an investment amount is small enough to feel manageable, it becomes easier to maintain the habit. Large financial goals often feel overwhelming. Saving thousands of dollars every month may seem impossible, but saving $100 often feels achievable, and once the habit begins, it can grow. Some people start with $100 and gradually increase their contributions as their income rises. Others begin with small amounts but develop the discipline that allows them to invest larger sums later. In both cases, the initial habit becomes the foundation for long-term wealth. But there is another reason the $100 rule works. It shifts focus away from short-term results and toward long-term thinking. In modern financial culture, people often chase quick gains. They search for the next hot stock, the next market trend, or the next opportunity to double their money quickly. But this approach rarely produces consistent success. Markets move unpredictably, trends change, and emotional decision-making often leads to buying high and selling low. The $100 rule encourages a different mindset. Instead of trying to predict the perfect moment to invest, it focuses on regular contributions over time. This approach is often called dollar-cost averaging. When investments are made consistently, regardless of market conditions, investors naturally buy more shares when prices are low and fewer shares when prices are high. Over long periods, this can smooth out market volatility. It removes the pressure of trying to time the market, and it transforms investing from a stressful activity into a routine habit. But habits alone are not enough. Where the money is invested also matters. Historically, the assets that have produced the most consistent long-term growth are businesses. When people invest in stocks or index funds, they are essentially investing in companies. Companies innovate, they produce goods and services, they grow, and as they grow, their value increases. This growth is reflected in the price of their shares. Over decades, the global economy has expanded dramatically. Technology has improved productivity, new industries have emerged, and businesses have generated enormous amounts of wealth. Investors who participated in that growth through consistent investment have benefited alongside those companies. This is why the stock market has historically been one of the most effective long-term wealth-building tools. But the key phrase here is long-term. Short-term fluctuations can be dramatic. Markets rise and fall, economic crises occur, recessions happen, yet over extended periods, markets have tended to grow as economies expand. The $100 rule works because it aligns with this long-term reality. Instead of reacting to every market movement, it builds wealth gradually through persistence. But there is an obstacle that prevents many people from following this rule: lifestyle inflation. Lifestyle inflation occurs when spending increases as income increases. When people receive raises or promotions, their expenses often rise along with their income. Bigger homes, newer cars, more expensive habits. While these purchases may bring temporary satisfaction, they often delay wealth accumulation. Because wealth is not determined only by how much someone earns, it is determined by how much they keep and invest. The $100 rule acts as a counterbalance to lifestyle inflation. It creates a fixed habit of investing before spending. Over time, this habit can expand. A person who once invested $100 per month might later invest $200, then $500. Eventually, the habit becomes automatic. Another reason the $100 rule is powerful is that it democratizes investing. For much of history, investing was associated with the wealthy. Stock ownership required significant capital. Financial markets were less accessible. But today, technology has changed that. Online brokerages, fractional shares, and digital platforms allow people to begin investing with relatively small amounts of money. This accessibility means that wealth-building strategies once limited to a small group are now available to millions of people. Yet despite this access, many people still delay investing. They believe they need large sums of money before they begin. They wait for the perfect moment. They postpone the decision year after year. But the truth is that the most important factor is not the size of the initial investment. It is the time spent invested. A person who begins investing small amounts in their 20s may accumulate far more wealth than someone who waits until their 40s to invest large sums, because time amplifies every dollar invested. This is why financial educators often emphasize the concept of starting early. Early investments have more years to compound, they have more time to recover from market downturns, and they generate returns on top of returns. The $100 rule captures this idea perfectly. It prioritizes starting now rather than waiting. But wealth building is not purely mechanical. It also requires emotional discipline. Markets can be unpredictable. There will be years when investments decline, periods when headlines predict financial catastrophe, moments when selling everything feels tempting. During these times, the habit created by the $100 rule becomes especially important. Consistency helps investors remain focused on long-term goals rather than short-term fear. Because the biggest enemy of compounding is interruption. When people abandon their strategy during difficult periods, they often miss the recovery that follows. Historically, markets have experienced numerous crises. Financial crashes, global recessions, political uncertainty. Yet over long periods, economies have adapted and continued to grow. Investors who maintained consistent contributions during those periods often benefited the most when growth resumed. Another interesting aspect of the $100 rule is that it changes how people perceive money. Instead of viewing money purely as something to spend, it becomes something that can work on their behalf. Every dollar invested becomes a small employee, working quietly in the background, generating returns, and contributing to future financial freedom. Over time, the accumulation of these small employees can become powerful. Hundreds of dollars become thousands, thousands become tens of thousands. Eventually, the investment itself begins generating meaningful income through dividends, interest, or capital appreciation. At that stage, money begins to produce more money. This is the turning point where wealth building accelerates. But reaching that point requires patience. And patience is one of the rarest financial skills. Modern culture often celebrates speed, fast profits, instant success, overnight stories of financial triumph. But the reality of wealth building is far less dramatic. It is slow, methodical, and often boring. The $100 rule embraces this reality. It transforms wealth building into a simple routine rather than a dramatic event, month after month, year after year. The process continues quietly in the background, and eventually, something remarkable happens. The results that once seemed insignificant begin to compound into something meaningful. The investment portfolio grows large enough that its own returns exceed the original contributions. At that moment, the engine of compounding is fully engaged, and the journey toward financial independence becomes much shorter. But perhaps the most important lesson of the $100 rule is philosophical rather than financial. It demonstrates the power of small decisions repeated consistently over time. Many aspects of life follow the same principle: health, learning, relationships. Progress often begins with small actions, actions that may seem insignificant in isolation, but when repeated consistently, they create powerful outcomes. Wealth building works the same way. The $100 rule is not really about $100. It is about commitment, it is about discipline, and it is about recognizing that the future is shaped by the habits we build today. Because in the end, most millionaires were not created by luck. They were created by time, consistency, and the quiet power of compounding. And sometimes, it all begins with something as simple as a single $100 decision repeated again and again, month after month, year after year, until one day, the small habit that once seemed insignificant becomes the foundation of lasting wealth. If you found this helpful, please like the video and subscribe for more.